A lot of people say, hey, is fintech in a bubble? I'd say you haven't seen anything yet, because most fintechs were spending most of their time getting the table stakes in place before they could actually execute on their big vision that was bringing something unique to the marketplace. Now you can do that in 3 to 6 months rather than 2 to 3 years, and you're going to get, in my opinion, a lot more unique innovation to the marketplace sooner.
That's Wade Arnold, the founder and CEO of Move Financial, and my guest today on Banking with Interest. I'm Rob Blackwell, Chief Content Officer of IntraFi Network and the former Editor-in-Chief of American Banker. When most fintech entrepreneurs talk about their firm, they usually try to sell you on how exciting it is, which is part of what makes Wade's pitch for Move so different. As you'll hear, he jokes about how they call it, quote, the most boring company in fintech, end quote. That's because it's targeting a fundamental part of banking, the payment system. In a nutshell, Move makes it easier for businesses to accept, store, and disperse money. Its mission statement is to help businesses do other things than worry about how they're going to make payroll, for example. But just because it doesn't sound exciting doesn't mean it isn't enabling big changes behind the scenes. Move is now used by banks and fintechs nationwide to enable things like banking as a service and embedded banking. It's why Move has described itself as, quote, at the core of fintech, end quote. Move recently won Visa's Everywhere Initiative, a competitive live-streamed program designed to help startups partner with the credit card payments network for both North America and the world. I got a chance to meet Wade while at a recent Iowa Bankers Association conference where he was a guest on a panel on real-time payments that I moderated. As you'll hear, he's game not just to talk about why he founded Move and where it goes next, but also discuss the many changes taking place in the payment industry overall. He talks about why so many consumer-oriented fintechs he works with are interested in getting banking charters, the rise of banking as a service and its importance to the industry, and how consumer expectations are driving innovations going forward. Before founding Move 3 years ago, Wade was the founder and CEO of digital engagement platform Banno in 2008, which was sold to Jack Henry in 2014, where Wade then served as a managing director for the next 2 years. He was also previously the executive vice president of technology at BillGo, a B2B payment engine that offers real-time payments. Wade, thank you so much for being on the show. It was a thrill to meet you at the Iowa Bankers Association convention. That was a fantastic time. So thanks for being here.
Absolutely. It's a joy to be on your show.
I want to start at the beginning. Why did you start Move? And if you had to give an elevator pitch for what it does for banks and fintechs and others, what would it be?
Yeah, absolutely. So I think the elevator pitch is we make it easier for software companies to accept, store, and disperse money, which most people say, well, haven't we been doing that since there was electronic money movement? And the reality, or what the motivation for creating this was, is that those are really disparate systems. So maybe the storage of money is, FIS, Fiserv, and Jack Henry, and they've got all kinds of different ways of storing value, and disbursement could be the clearinghouse or same day ACH or a virtual card. So all kinds of ways of moving money and then accepting money, things like ACH, merchant acquiring, wires, all kinds of ways that comes in. And Move, I think in the industry, if you were just to pick one of those silos, there's lots of competitors that do them extremely well with tons of features, but there's not really a company that does all of them seamlessly with quick access to funds. So for those more complex workflow, the product works really well. And what we saw was that the world was going towards these vertical SaaS companies, marketplaces, or platforms where it wasn't just the brick and mortar that chose to go online and they need to accept money and get their money back to their bank account. It was something new. It was the influencer on a platform that wanted to be tipped by their constituents, or the next Etsy, or the next Airbnb, Uber type marketplace. And there wasn't a payments platform that was really designed both in underwriting and licensing and payment rails for that emerging market.
And I know this isn't your first rodeo as a founder. You started Banno in 2008 and ran it until it was bought by Jack Henry 6 years later. What did you learn in that first go around that helped you be a better entrepreneur the second time?
Yeah, I think the biggest takeaway is we were really focused at Banno on our engineering and product culture. I think that we truly cared for the craft and and the team that was built there that's still, kicking butt and taking names today is really, really great culture in that area. I don't think we were super great at marketing and sales and kind of all the other motions of the organization. It was definitely a tech-focused founder company. And this time, everything from our chief people officer to how we do, social media to how our sales and go-to-market strategy is also at that kind of high level of excellence. So same values around really caring about the craft, but doing that for the entire organization and not just product and engineering.
I mean, how has that panned out? You feel like building that culture from the sort of start has made it feel significantly different and helped the second time?
I believe so. So my 11th hire was a chief people officer. My first C-level hire was somebody in charge of keeping the culture for the organization. And I think that that's indicative of your question, what's different. And for sure, instilling those values and doing what we preach from day one was really, as both an investor and previous founder, I've just seen companies that they get to 80 or 120 or 240 people, and now all of a sudden those values are more of the bullet points on the brass plate out front of the company. And so it's really critical to keep that culture as long as you possibly can. And I think some of the most successful companies that are around today have done that at large scale.
Every year, Visa holds a competition called Visa Everywhere Initiative. And it's basically like I don't know if we'd say it's a reality show or a Shark Tank to see who it will be its next partner. And I know that in June 2021, Move competed. You were selected as a finalist from about 600 applications, and you won the North America competition, which I think brought with it $10,000 in partnership. And then just last month, you did it again in a worldwide competition, which brought in $50,000. So can you tell me more about that experience, what it was like, and what does it mean for Move that you won it twice?
Yeah, absolutely. So the program definitely was that Shark Tank feel in that it was a 4-minute spiel. And I think your intro question was, what does Move do? Can you imagine trying to distill that all down into 4 succinct minutes? So I probably should have that at the top of my tongue, but it really was this great program. With the competition was incredible, especially on a global scale. Regardless of kind of the outcome, the value was being able to work with product managers at Visa, understanding what was on the roadmap. If you go to visa.com, there's lots of links. So being able to navigate the large company that is Visa into figuring out how to, as a new startup, to partner with them and get to market quickly. And so that's been regardless of the prize money, which nobody complains about, the biggest advantage definitely was being able to get integrated with Visa at an early stage company that maybe they would have waited until you had more product market fit or more runway from a revenue standpoint before they'd give you that unfederated access to their organization.
Well, it's fascinating. I watched a bit of it when I was preparing for this, and you seem absolutely completely calm during the whole thing. Right as they're announcing the finalists, I kept wondering, did you know you were going to win ahead of time? I mean, you don't seem nervous at all. I don't know if you're holding it all on the inside, but you have a really good poker face.
I think at this stage of my career, winning or losing a Visa award is less stressful than payroll and fundraising and getting the next big customer. And so people get nervous when they truly care about something. I cared about it, but not to the maybe extent that it was life-changing to me, whether or not I won or lost that contest.
Right. What did you learn out of it? Anything?
For me, I think it forced us to have a more concise message to the marketplace, and that's hard for us. We like to say Move's trying to be the most boring company in fintech because we're doing things like ACH and wire and wallets and RTP, but none of them onto themselves are anything new, right? We were selling ACH processing software on punch cards, so frankly, it hasn't changed all that much. But the root of what we're trying to do is have this infrastructure that's directly tied to the payment networks, that's cloud native, that's highly scalable, that's fault tolerant. And so for fintechs that have hit some scale point, those are really good attributes about their vendor. And it's not that if you compared us versus somebody else in an RFP and, do you do this, SEC code of an ACH file? It's, do you do this SEC code of an ACH file? And you can send 7 million of them to us 1 minute before the ACH cutoff time and everything, works as planned. That's where we show up and differentiate. Whereas a lot of competition is talking about the consumer or the business that they're helping. That's our customer that's building that value-added product on top of us. So, definitely a platform company to an industry that's really used to buying solutions for specific problems and not platforms.
Is that the tagline you want to go with, or the headline for this podcast? Meet Move, the most boring fintech out there?
Well, we always compare it to something like a web server or a load balancer or a database. Like, nobody puts on their website that they use a database that doesn't lose data. But there's a lot of people that use payments companies that miss payment windows.
So what's next for Move?
Our big thing is we've really started focusing on all of the Fed protocols, right? ACH, wire, image cache letter. And then from there, we went straight into directly connecting to the clearinghouse. So we went through the certification process in order to be a certified send point and request for payments on the clearinghouse. So that's where Move is today. And obviously we've got a wallet and ledger and account numbers and routing numbers that you can send money to and fro on that. The big next thing for us is we just became a registered PayFac. And so we're going through the certification with Visa in order to do card not present acquiring. And we're doing that in a unique way where we have 8 settlement windows a day. So that allows us, rather than that nightly batch file, if you accept a card in the morning, an hour later, you can spend that money as well, because we'll have settled that. And that time to access the capital is just really important as a feature for, the marketplace or platform type companies that we're working with.
I wanted to flag something. I've talked to several fintech entrepreneurs, and it seems like generally, it can't be literally true, but generally I'm speaking to people out in California or San Francisco, or then on the other coast in New York City. You come from a very different background. You grew up, went to school in Iowa. You now live in Colorado, but I saw how the Iowa bankers treated you, which was like a local boy made good. And obviously the Midwest is known for certain industries, insurance being one of them, agriculture being another. But do you think it gets overlooked when it comes to fintech and banking?
I think that the Midwest work ethic goes extremely well with financial services. And that is, there's a lot about the Silicon Valley mentality that I embrace, but little things like fail fast, and roll back if it doesn't work, doesn't really work when it comes to financial services and SOC 2s and PCI compliance. You can't fail fast and lose all your card numbers. And so I think that mindset of this is going to be hard is kind of maybe it's just from the Midwest winters. It's going to be hard, and there's no shortcuts in financial services. So you really have kind of a Gantt or methodical way that you have to go bring a product to market. And if you miss some of those steps, you can be fined, business can go under, all kinds of things. So I think that plays well to the industry we serve and the other industries that you mentioned.
When you're looking out across the banking and fintech landscape, what innovations, what innovative companies are you tracking?
For me, it's kind of these aggregators of services that are really interesting to me. So previously at Banno and then also at Bilgo, you spent a lot of time building out pieces that you had to build just to make it work. And so something like KYC or KYB practices, TIN matching, Dun & Bradstreet integrations, like all of this stuff you have to do first, and then you build your product on top of it. And so I'm excited about companies that are building that infrastructure layer as an entrepreneur, because I think we'll see more innovation come to market faster. A lot of people say, hey, is fintech in a bubble? I'd say you haven't seen anything yet, because most fintechs were spending most of their time getting the table stakes in place before they could actually execute on their big vision that was bringing something unique to the marketplace. Now you can do that in 3 to 6 months rather than 2 to 3 years, and you're going to get, in my opinion, a lot more unique innovation to the marketplace sooner.
When you and I were talking earlier for this panel, you happened to mention to me that every consumer-oriented fintech that you knew of was thinking about getting a bank charter. So can you expand on that? Do you think most of them are seriously considering one, likely to get one? And if that's true, what does that mean for banks that have partnered with fintechs and maybe those fintechs are going to go direct? Or what do you think it means for the bank fintech relationship dynamic?
Yeah, so on a clarification, the companies that I'm watching most closely have recently gone either public via IPO or SPAC. And so now all of a sudden you have an EBITDA maximization challenge and a speed of iteration of product and market, product to market features. And so in those two areas, the fintech bank sponsorship is either going to get price compression, right, which is, hey, I need that per transaction fee, or my interest rate on my deposits. I need margin out of this because I'm hitting some scale point. And there's got to be some spreadsheet internally that says cost of getting a charter is $10 million a year. My spread on what I'm currently making is $9 million a year. I'm going to stay with my bank sponsor at this point. When that becomes 15 or 20 million, why not take on the regulatory burden, put it in a subsidiary and bring it to the market, especially if it allows me to iterate on my product features faster. Way more important in the lending space, rather than going to my bank sponsor to approve a new lending program, if I could bring that in-house and do it myself. I think the other unique thing that's happened is that bankers weren't willing to go to fintechs before. Bankers are willing to go to fintechs now. And so there used to be this, why would these tech companies want to have a bank charter? Well, they can because the bankers are willing to come to the tech companies. And I think that's new inside of the last couple of years compared to a decade ago.
It feels like it really has shifted. In part, one of the interesting things about being at both conferences is I heard from bankers in Texas and Iowa that they were much more willing to partner with fintechs than previously I had thought them to be, and many seemed like they were reluctant before.
And I do think there's a big difference between, Move as a fintech that facilitates payment processing for and storage of value for software companies, than I'm Chime and your bank sucks and I'm making a better bank. That may be a little bit different feel to be their sponsor.
I think one of the big worries bankers have is sort of who's in front of the customer. You're not trying to be in front of their customer, right? So it's easy for a banker to work with you because the retail customer won't know what Move is, and that's not the idea behind it. I wonder how much that changes when it is like Chime. Chime wants to do it, and you're providing a service to Chime. So I guess when we talk about banking as a service, do you think that poses a risk to banking? Are banks in danger of becoming utilities?
So to me, banking as a service has been around since computers were around, in that they wanted automated treasury and all of these other things, and they wanted a computer talking to a computer rather than a teller on a phone talking to a controller at the business. It just was unevenly distributed. So if I was Boeing, if I was John Deere, if I was Fortune 100 company, my ERP system talked directly to my Citi or Chase or a Wells Fargo account. Why I think banking as a service is a kind of in a boom now is it's not just the Fortune 100 companies that want automated treasury. They're used to that type of integration in maybe their Shopify account, and now they're expanding. Why doesn't this work in everything else I do in a more automated way? And not just automated data, but actually transactional inside of these systems. And so if I'm running, my brewery or my bike company, I want those things just to work, rather than, I need to transfer some money out of my bank account to my payroll provider. Why can't I schedule that and automate that in a more integrated way? And now that's a business that's, a multi-million-dollar in revenue business rather than a multi-billion in revenue business. And so I think those capabilities are just kind of coming down market versus something new in the marketplace.
I know when I was watching you speak at the Visa competition, it said you mentioned how you were involved in Ethereum very early on. Bankers have been skeptical of cryptocurrency. I mentioned in the panel we were on that we did a survey recently where it was like we went out and asked if you'd be willing to engage, and some 500 bankers came back answering the question. 85% of them said no. I mean, they weren't going to offer crypto services of any kind. But I have heard anecdotally of a few banks that seem to be changing their minds and were talking to me. So what's your view when it comes to crypto and banking? Are banks missing the boat here, or are they right to be cautious and wary?
For me, it's what's the purpose of it? Like, what's the utility that it's creating? And I've heard of banks that they currently don't allow you to buy Apple stock through their online banking, but they're pondering being able to buy Bitcoin through their online banking. That doesn't add up to me. Enabling my customers to have some speculative asset purchase through my digital banking, that sounds like a hype train so that I can say my bank supports crypto. You juxtapose that to kind of the utility of crypto, and maybe I have commercial customers that want to use crypto for paying independent contractors globally, and it allows for this great utility to pay their vendors or pay independent contractors without huge FX transfers, without huge wiring fees. That starts to sound really interesting to me, and I think those two things are really two different motivations for getting into crypto. One is a utility function, really just another payment rail, versus a speculative asset purchasing, which I don't know how that's going to end. I've sold all my Bitcoin. How about that?
Well, it's interesting you bring it up because I want to talk about stable coins, which I guess are that way of doing crypto without the speculation on top of it. So
the speculation actually ruins the utility, right? So the value of crypto is having a stable monetary conversion rate. So if I'm sitting in Brazil, and I've experienced 1,000% inflation in my lifetime, and I'm doing independent contracting as a software developer for a US company, what currency do I want this in? As a stable currency that Bitcoin used to be, where it just kind of sat around $800 a Bitcoin, I'll take that in Bitcoin rather than local currencies volatility. And as Americans, we're real used to being the stable coin of the entire world called the US dollar. And so kind of that fluctuation in currency value, most Americans don't get that compared to if I lived in Venezuela. All of a sudden, I'm way more interested in this less volatile asset, regardless of what it's backed by. And so I think the utility of cryptocurrency being a payment rail, no different than international wire or SEPA or some of the other rails that are out there to transfer value across the globe, is highly diminished if the value of the crypto underlying crypto asset is changing all the time. Now all of a sudden, maybe I do want to just pay an FX transfer on a Visa Direct debit card push. And so the adoption of crypto as a payment rail, I think, has probably slowed by the speculative nature of Bitcoin or Ethereum as a speculative asset, which gets me excited about things like stable coins, because now you have this more grounded asset. You can forecast it. You're not checking a price point at the second of the transfer in order to make that happen.
I guess I have two questions. The first is, why do I need a stable coin if we ever achieve real-time payments in the US, which I will concede right now we don't have? I mean, I get this. I'm sending, wires overseas, but I mean,
Networks is a real-time payment network.
Right. And so it is. But I mean, if we have real-time payments, why do we need something that can move, across borders in the same way? I guess that's the piece of it I'm missing.
So I think competition is great, and the current gas rate for doing a crypto exchange is almost the same as interchange on a card. And so you're getting no economic gain in using crypto versus a card. You're getting a huge economic gain versus FX transfer wires right now. But to your point, I think it's more going to be tied to the global utility of it. And then what areas of our economy does the global utility of it really, really matter? So maybe paying the independent contractor in Argentina low utility. 1 million people or 100 million people in a video game that are constantly exchanging value globally, that utility is much higher than the remittance use case. So I think it's going to create some of these additional use cases that specifically maybe we start off with gaming and then it's social influencers, et cetera, that the gain of the utility of that is much higher.
And is that coming from a fiat digital, central bank digital currency, or is it coming from a private company? And I guess I'm thinking, I know that you've worked with Facebook's DM, which would be an equivalent, or someone like that providing it, a big global company with the sort of wherewithal to bring that kind of force into it.
Yeah, so I think I see two use cases there. So like Ethereum specifically, kind of, you think of popular video games are not uncommon to have 100 million players on them that all have some stored value inside of their system. So that's one use case. On the stablecoin side of things, the ability for on a kind of a layer 2 or Lightning Network type protocol for two large multinational corporations to exchange value in real time is super interesting, right? So the ability for Uber Money to transfer value to DoorDash and back in a non-treasury way, in a very automated way, it is another great use case. So typically that would have been done on a daily net settlement, maybe a wire, versus throughout the day as Uber's paying a Dasher or Dasher's paying Uber, and now it's on a per transaction level that's settling constantly. I think the utility of crypto is super interesting, especially in a stablecoin way for those type of user stories. And that's where, back to your first question, should a bank be getting into this? Well, if you're the bank that's got $1 billion loan with Uber, you probably should be, right? How do you help them? Because that's now a new commercial treasury product versus should we be in, crypto or big data or AI because it sounds cool? Probably not.
Right. Always the worry that there's a lot of this, it feels like hype around it and feels like fear of missing out is the big thing, right? It's FOMO. It's everybody worries that they're missing some big opportunity. And it feels like when you're talking about Bitcoin, you already missed that opportunity. There's no sense in getting in now.
Yeah, a great user story that we're working with right now that's kind of making us tiptoe around the edges of some of this is just tipping inside of social influencers. So, the prohibitive cost of me enjoying Rob's podcast and giving you $1. So, a lot of companies are going to charge 50 cents for me to give you $1. Is it even worth me tipping you $1? If I tip you $1 on Ethereum, it's probably worth it. And now you have the ability to accumulate a lot of this crypto asset over time. And then at some point, if you choose to settle that into a fiat currency, you're doing it at a collective level, right? You've gotten enough dollars a long time versus the way it would work now. If you had a merchant acquiring agreement for me to give you $1, it just may not happen.
So when you look out over the payments industry and the banking over the next few years, how do you see it changing? What do you think it looks like in 4 or 5 years?
I am so excited about the clearinghouse and request for payment. I can't even stop with how many use cases my brain goes with for that network, and I'm very hopeful that FedNow is interoperable standard with that, so that we're not trying to do a least cost routing across these two different payment networks. It reminds me a lot of Visa and MasterCard used to not be interoperable, and once they settled on the same protocol, now you had a monopoly with two players rather than two competing entities for the same idea. So FedNow to me is FedNow and RTP to me is the thing that can allow financial institutions and small businesses and large businesses have that same instant settlement and instant notification, which is what consumers love from things like Cash App and Venmo, but it's actually fiat money being moved. And so I don't think it's unrealistic for the plumber to want to be paid with FedNow rather than card for the babysitter to get paid over that network versus needing a Square dongle, because that's the only way that they can contractually get the money for the service before they leave. And so to me, I couldn't be more bullish on how that's going to change how commerce works, and probably a lot of it that's over check and cash today becoming digitized.
So checks will finally die?
No, they're never going to die, because we keep on getting more humans, and cash is going to be around forever too.
But you were saying you can see so many, use cases for it. Can you take me through any others?
Oh, one we're working on, which is actually a cash conversion, is a lot of millennials that are wage workers want to be tipped out at 2 a.m. when they're done working at the restaurant. A lot of those tips are in cash. So now what? And so it's actually a big need to take that cash and tip them out instantaneously over RTP. Now I've finished up my night at work. Here's my tips, and all of a sudden I've got $123 into my bank account instantaneously. So all kinds of unique use cases, but the driver is that people not wanting cash, not wanting a check, not wanting to have to do labor after being paid just to get the asset. So that immediacy to capital, anytime people want money faster, I think that the RTP is a great solution for that.
That's terrific. Is there anything I should have asked you that I didn't? I feel like there's so much in this space and I'm not even aware of.
Oh, I don't know. I love talking about this stuff. So
no, you seemed it on stage too. It's the great payments have really changed a lot already in the past 5-10 years.
For sure. And then I think consumer demand, consumer expectations is really the big driver. And so for most of my friends that aren't in the fintech stratosphere, right? They truly believe when they use Venmo that it goes from their bank account to the recipient's bank account. They have no clue that there is any difference between Venmo and Zelle. It's ubiquity between the two. And so to me, that's the new consumer demand. Those people are running businesses now. Those people are in charge of decision making, and the expectation is that's just how the world works. And so we as kind of technologists in this space need to get solutions in place that meet that consumer demand.
Wade, this has been a great conversation. I want to thank you so much for coming on the show and talking about this, and hopefully we'll be talking about it more over the next few years.
Awesome. Thanks, Rob. Thanks for having me.
Jerome Powell's term as chairman of the Fed isn't due to expire until February, but the question of whether he will be reappointed is already reaching fever pitch in DC. It's been no secret that progressives are lobbying President Biden to appoint someone else, most likely Fed Governor Lael Brainard, as chair. They've argued privately and increasingly in public that Powell's not been tough enough on bank regulation, accusing him of weakening standards and, among other things, allowing big banks to pay dividends during the pandemic. His supporters, however, argue that the regulatory changes he presided over during the Trump administration were marginal at best, and that the Dodd-Frank structure in place during 2010 is almost entirely still intact. Moreover, many point to Powell's performance during the pandemic when the Fed took steps to ensure the economy did not fall apart in the midst of a global health crisis. Until recently, the going bet in DC was that Powell was most likely to get reappointed, but recent revelations that top Fed officials traded in their personal accounts last year have provided ammunition for the Fed chair's critics. Powell himself has not been accused of wrongdoing and has called for tougher standards regarding the personal portfolios of Fed leaders, but it's provided a new opening of attack for his foes. So what's going to happen? I'm not sure, though my gut still tells me Powell has the inside track here despite the recent trading scandal. One thing I know for sure is we're due to find out an answer very soon. Fed chair nominations are typically announced roughly 3 months before the current term expires, which means a decision is likely to be announced from the White House in the coming days or weeks. And that's all from me this week. Banking with Interest is written and produced by me, Rob Blackwell. Sound engineering and mixing are done by Pat Fells and Tae-Soo Chang. Our theme song was written and produced by Stellar Tracks, courtesy of Pond 5. The information, views, and opinions expressed during the Banking with Interest podcast belong solely to myself and my guest and do not represent those of InterFi, its directors, management, or employees. Any ideas and strategies contained within the podcast are for informational purposes only and do not constitute legal or investment advice. If you like what you hear, please leave a rating or review on the podcast platform of your choice. Banking with Interest is available on iTunes, Spotify, Google, Stitcher, and Amazon Music. New episodes debut each Tuesday. Stay safe, stay healthy, and we'll see you next week.